price of this pair will go up, and if the pound is weaker, or if the pound is stronger, if the pound is stronger than the euro, then the pair will go down. So it's always, if the currency on the left is stronger than the one on the right, the pair will go up, and if the currency on the right is stronger than the currency on the left, the pair will go down. So what you want to do to view these pairs, is open up a website that's called tradingview.com. After you've opened this up, make an account on it. Of course, sign up. After you've done that, go over here, scroll over and click products, then hover over and click chart. After you've clicked chart, you'll see this white background with green and red candles, whatever. What you want to do is, you want to come up to the top right, create a new list, call it something like Forex, for example, for your first list, call it Forex. And what I have here is the top 28 Forex pairs that you want to trade. You don't want to trade any other pairs other than these. Now, it's advised to only trade a couple of pairs, but I'll get onto that later. These are the only pairs you want to look at on your watch list. You don't want to look at any other pairs. These are the only ones that matter. So take a screenshot of this, write these pairs down on a piece of paper, on notes, whatever. After you've done that, you have them, come over to the top right of tradingview.com. So this plus sign in your watch list. Come over to Forex. And as you can see here, just start adding in all of these. So the first one is Euro GBP. Just click the first one that comes up. Bang, Euro GBP. The next one, Euro AUD. Click the next one, and so forth and so on. Now, another thing for TradingView is the colors. The basic colors is a white background and a green and red candlesticks. It's actually better, people will say, and what I would advise as well, is you come up to the top right to this cog and click on symbol and change the colors of these candlesticks. The green ones if price is going up, of course, for example, Euro CAD. If the euro is stronger than the Canadian dollar, the price will go up, forming green candlesticks. It's advised to change these candlesticks to a different color, such as blue, if the price of this is going up, if the price of this asset is going up, and something like black, if it is going down. Because green and red, for some reason, if you're... Alright, look, I won't get into it now, but it's better psychology to have different colors. Up to you. That's episode 1. That's what Forex is. Thanks for watching. Alright, episode 2, alright, what are candlesticks? So this is an important video for beginners. This is how you're going to start understanding the charts, how you're going to start reading the charts, right? Because you're going to be using candlesticks to look at the chart, right? You're going to be using candlesticks. It's the most popular thing, it's the easiest thing, and you just have to know how to read them, right? So this is going to be just a basic video, right? You can write this down, you can save these images, whatever you want, right? So what actually are candlesticks? Well, what do candlesticks do? So what they do is they represent how much price moved within that time frame. So right now I'm on the 1 hour. If I got a candle like this with a bullish candle, it represents how much price moved up in that 1 hour, and with a bearish candle it shows how much price moved down in that 1 hour. So where do these candles open and close? Well, right here for a bullish candle means price is moving up in that hour. We have the open of the candles at the bottom. Right, we got this bottom line here. That's where the candle opened. So when the new hour came, say it went from 1 o'clock, it went 2 o'clock happened. Right, when it turns to 2 o'clock, this is where the candle will open, and when it turns to 3 o'clock, this is when this candle will close. Right, and for a bearish candle, if you're on the 1 hour time frame like I am, this is the same thing for every time frame, right? But if I'm the 1 hour like I am, for a red candle, a bearish candle, the downwards candle, this is where price will open. This is where the candle will open on the new hour, and this is where it will close when the new hour comes. So pretty basic, right? So what are wicks? Wicks just show wicks actually are just these lines on the top of the bottom of the candles, right? They're on every candle, but some don't have them, but pretty much every candle you see, they're the same for either a bullish candle or a bearish candle. What they show is the top wick shows the highest price that candle reached within that time frame, and the bottom wick shows the lowest price that it reached in that time frame, right? This is the same for every candle, right? So important candlesticks, right? So these are like the main candlesticks you're going to see in the market. These are the things you need to know what they are, right? So you have a bullish candle. This shows prices moving up. So of course it opens here, closes here. That means prices moved up within that time, right? And for a bearish candle, it shows how much prices moved down within that time. So I'll find an example real quick. So you can see here, this is a bullish candle because it moved up in that time, right? And then it closed, and that's how much price moved up. Or a bearish candle, here's a bearish candle. This is how much price moved down within that hour. So we got a couple candles here that I'm going to show you. You can write these down, take a picture, write some notes, whatever. We got a bullish engulfing candle as the first candle I'm going to show you. We got two types of engulfing candles. So we got the bullish engulfing 1, bullish engulfing 2, and the same for bearish. So bullish engulfing, right, 1 is when price is moving down. Recently, you got a series of bearish candles. Then you see a bullish candle forming, and you get this kind of, the body of the bullish candle closes over the wick and the body of the bearish candle, right? So what does this mean? It usually means that after you get this engulfing candle, it's price will probably reverse. You'll probably get a pullback in the opposite direction. So it comes down, you get a bullish engulfing candle, it clears the body and the wick, and then the next candle will most likely be green as well, and it will continue upwards. This is the same thing for the second type of engulfing, but however, these engulfings, they don't clear the wick of the recent down candle. All they cover, or all they clear, is the body. It'll have the same reaction, it'll probably still move up, but these ones are stronger than these ones. It's vice versa for the bearish ones. You have a series of up candles, you get a bearish engulfing, it closes below the wick and the body, and what you'll probably see, most likely you'll see a series of bearish candles moving in the opposite direction after this. Same thing with the bearish engulfing 2, same as the bullish engulfing 2. It clears the body, but it doesn't clear the wick, so you'll probably see some more bearish candles after you see this, right? You probably see more downwards movement, but this, you just know that bearish and bullish engulfing 1s are stronger than the 2s, alright? The next thing you're going to see on the chart is a rejection candle. So for a bearish rejection candle, you'll see that price would have been at one point up here, so it would have been a bullish candle at this point here. People started selling it and it turned into a bearish candle. This shows that there's lots of sellers, there's high selling pressure on this chart, there's high selling pressure in the market, and after you get this type of candle, usually you'll see a move down in the opposite direction. So kind of like the engulfing candle, but this, instead of it happening over 2 candles, you're going to get this in 1 candle. So it's kind of like an engulfing, but in 1 candle, basically. Same with bullish. After you get this kind of wick, you can see, or you can anticipate a move upwards. Again, like an engulfing candle, but in 1 candle, right? And the last thing before I show you some examples is the doji candle. So what this is the body of the candle is extremely small and the wicks are quite big. The wicks are equal size on either side, and the actual body is extremely small. So what this shows is that within this candle, if you go to a lower time frame up here, the candle is moving like this, alright? So you got sellers selling up at the top and you got buyers buying at the bottom on a smaller time frame. So the market, you call it indecisive, it would be a choppy market, it would be a volatile market if you get a couple of days. And usually, if it's kind of doing this on a smaller time frame, after this candle closes, you're going to see a move in the one of the other direction. Very rarely do I see a doji candle and then it doesn't do anything after, right? Usually you get some sort of move up or down off a doji candle. So I'll show an example of engulfing candle here. Let me try to find one. Engulfing candle. Right, there's one there already, engulfing candle right here. You got a series of downwards candles, a series of bearish candles. You get an engulfing candle that clears the body and the wick, and you can see how far it moved off this. So if you were even to take a trade off this engulfing candle, if you see, okay, it closed, it's engulfing, I would place a trade here, stop loss, wherever, and you could have made money off that, right? So here's a bearish engulfing as well. This doesn't actually matter. Again, bearish engulfing green candle turns into a red one on the next one, clears the body and the wick, and you move down. It wasn't as big a move, but it still moved down. It didn't just do this and then go up again, right? Next candle, what the fuck is the next candle? A bearish rejection candle. A bearish rejection. Here's a big fat one right here. A bearish rejection candle. What this shows, or I already explained that. So as you can see, you got a bearish rejection and it moved down very fast. Now it was a short-lived move, but if you're seeing this happening in real time, you can see that the next couple of hours, or however long you want it to be, or however long the time frame is, you're going to see the next couple of candles are going to be big and red, right? So always a rejection candle always almost shows a reversing in price, and here is a bullish candle, right? A bullish rejection. Now the interesting thing with this is that the price didn't actually turn bullish on this candle, but you still got a bullish rejection. So the price didn't have a rejection then turn green. What it did was it had a rejection and stayed there. It closed before it could go green, it closed before it could go bullish, but you still got the bullish rejection because the wick on the bottom was huge, right? And there you go, there, like butter, right? It just moves upwards after that, right? And the last candle, a doji candle. Right here you can see a doji candle, right? Body extremely small, wicks are pretty big for the size of the body of the candle. So as I said, usually if there's a doji candle, you're going to see some sort of move off it. Like I said, like here, right, you got two doji candles and it didn't really do anything, but that's kind of unlikely from my experience anyway. Look, you get dojis all the time. All it's doing on a lower time frame is moving up and down pretty much, right? So there you have it. That's what candlesticks are. Bullish candlesticks, bearish candlesticks. You got the three most probably important candlesticks as well, and you just learned all that in about, I don't know, 5 minutes, something like that. So yeah, that's an important lesson. Take a picture of this if you want. If you're a beginner, take a picture of this, write it down, do it out in your own chart, look for examples. There you go. Alright, lesson 3, episode 3. Market direction. It's an important thing to know. It's very important for beginners to learn this early on. It's a very important part of the market, and you have to know how to identify market direction and develop a bias and market structure. By just looking at the chart in a couple of seconds, you can see what way the market is going and what you should be doing based off that. So what actually is market direction? It just shows you which way the market is going recently. So, you know, if you got more buyers than sellers, you're going to be in an uptrend. If you got more sellers than market is indecisive and it's kind of bouncing in between 2 points, you're going to have a range, right? So basically, this is an uptrend, and what an uptrend will do is it'll make a high point, it'll make another lower point, but it won't break this low. It'll just make a high, then it'll make a higher low, they're called. It'll break up to make a higher high. It'll have a pullback to a lower high or a higher low, and it will come up to a higher high, and so on, right? And then it's basically the opposite for a downtrend. You'll have a move down and make a lower low, then you'll come up for a pullback, make a lower high, come down, lower low, lower high, so on, right? And then the third and final main market direction, market structure is a range. So what you have here is when price makes a low point, makes a high point, and then it just bounces off these points, right? It can consolidate, or this is also called consolidation, accumulation, whatever. It can do whatever it wants up here, right? It can make an uptrend in this here. This can be a downtrend on a lower time frame, right? And it's just bouncing between this high point here and this low point here. And the reason it's not perfect, these things are imperfect, is because they're never going to be perfect on the actual chart. You're never going to see a perfect uptrend or a perfect downtrend or a perfect range. They're always going to be a bit like messy, right? And you just have to work with that. So something interesting actually about ranges and uptrend, something interesting about market direction, they and the importance of time frames, right, is in an uptrend, say on the 1 hour, you can see, okay, it's an uptrend, right? But if you were to go down on the 5 minute chart, you could see maybe on this pullback here, this little pullback, right? On the 1 hour it's an uptrend, but on the 5 minute, if you were to go in here, it would actually be a downtrend. So this kind of template will be inside of one of these pullbacks, and then you would have an uptrend, then you would have a downtrend, and you would have an uptrend and a downtrend on the lower time frames. So it's kind of how time frames work. It's the importance of time frames. Basically, you have to check out a lot of time frames to see the actual movement of the market. You got to check out your market direction on a higher time frame, like the 1 hour or the 4 hour or even the daily, because if you're on the 1 minute or the 5 minute or the 15 minute, you're going to think, oh, it's in a downtrend, when in reality, if you zoomed out a bit, it's going to be in an uptrend, and vice versa, right? So for example, what we have here, you can probably spot it already, is a downtrend. So we're breaking the lows, we're making lower highs, lower low, lower high, lower low, lower high, lower low, lower high, and so on until it hits a low point and then makes a range, right? So of course it's not perfect. It doesn't look exactly like this, right? You know, it doesn't look exactly like a downtrend, right, that I have laid out here, but it is obviously a downtrend. So if you're on the 1 hour time frame and you want to take a trade, you're not going to take a long position unless you're probably, if you're a beginner, you only want to trade with market direction. That's why it's so important, is you only want to trade with market direction if you're a beginner. So if it's in a downtrend, you want to only take short positions, you want to only take sell side trades. And in an uptrend, you only want to take you only want to take long positions, you only want to take buy side positions. So again, as you can see, may say higher low, higher high, higher low, higher high, higher low, and what I can anticipate the euro yen doing next is going up here, right? So down around this area, or around, around this area, judging by the way it's been doing shit and the way uptrends work, you could be looking for a buy position around here, right? Because that would be with the trend, and that would be a reason. So there's an uptrend and a downtrend in the market right now, and there's one more thing, the range, which I have over here somewhere. Let me find it real quick. Right, here's a range. So as I said, it makes a low point and a high point, and then it just kind of bounces along this. Now it's not perfect, but you can see there's no uptrend in this. There's no downtrend. There's no kind of, it's not really going up or down. There's no uptrend. There's no downtrend. It's just going, sideways pretty much, and eventually it'll break out of this and move on with an uptrend probably, or a downtrend, or it might fall out and make a downtrend. But those are the three constant market directions that the market is always going to be in. There's no other way for it to go, right? So they're going up, down, or sideways, and you have to know which one it is. So as I said, a few tips for identifying the market direction and knowing which way the market is going is, instead of being, say, on the 15 minute, you could say, oh, it's a really big uptrend, right? We're in an uptrend, we need to take buy positions. Or if you're on the 5 minute chart, or I don't know, you're on the 1 minute chart or something, right? You go to the 1 minute chart and you say, oh, well, it's actually a downtrend right here. See? Wait, I can't even zoom in. But you can see here, if you're on a 1 minute, you can see, oh, it's a downtrend. But if you zoom out to, a bigger time frame, like the 5 minute, you're going to see it. Hold on. You're going to see this as an uptrend. But if you zoom out to the 1 hour, you're going to see that all it is a range. Right? So that's the importance of time frames, and kind of using them to develop your market bias. So basically, what's the point of knowing this? It's that if you're in an uptrend, you want to only take buys. If you're in a downtrend, you want to only take sells. If you're in a range, you can take either side if you want. You can just short the top and buy the bottom if you want. So that's why you need to know, because a lot of people lose money just because they don't know how to identify the trend or the market direction, right? So that's pretty much all you need to know. There's no need to go deeper into it. Just use your time frames accordingly and only trade with the trend. I can't stress that anymore. Trade with the trend. Alright, episode 4, support and resistance. This is an important episode, again, another important episode after the market direction. This is going to be the building blocks of your technical analysis. This is how you trade in a range. This is probably the easiest strategy you can use, is support and resistance, right? So you better watch these videos in order, by the way, because each video is a building block after another video, right? Every video is a building block to another bigger video. So support and resistance, what does it mean? Support and resistance is simply just support. When price bounces off support, it goes upwards. When price bounces off resistance, it goes downwards. They're just zones. The chart works like a pinball machine. It bounces from one zone to another, and those zones are support and resistance zones. They're points of interest. So what does it look like? Here's what a typical support and resistance zone would look like. If you watch the last video, it looks a lot like a range. That's how you trade in ranges, is using support and resistance. The top line here is a resistance line. Every time price hits the resistance, it has a down move. Vice versa, every time it hits a support, it has an up move, right? Simple. You know, take a picture of that, snip it, whatever, save it. That's just basic support and resistance. So number 3, what are some examples? So I have a few examples written out here, or not written out, drawn out basically. So support and resistance, here we have a range, right? After a downtrend, we have a range to continue down. So in the range, we have a high that's formed after the down move, and this high is hit repeatedly to give sellers points to trade. So every time it hits this point, it moves down, and vice versa on the bottom side. Every time it hits this low point multiple times, it has an up move. So this happens all over the chart. Here's another one right here. It bounces, it has a low, which makes a high, which bounces like a pinball machine, and eventually it breaks out. Same here, it bounces, eventually it breaks out. Same up here. You even have a really small one up here, right? This would be a 1 minute range, right? It bounces it multiple times. You have the high zone up here, and it breaks out, right? It's kind of like a wedge, basically. It's kind of like a squeezing thing, support and resistance, right? Eventually it's going to break out, and that brings me on to my next point. How can you trade support and resistance? So by looking at the chart and identifying your support and resistance zones, how can you trade support and resistance? There's 3 ways to trade it. Number 1, being the most basic way to trade it, is to just buy and sell support and resistance lines. So if you identify a support line, you identify a low that's maybe been hit twice, or you identify a low, you identify a support zone, you just buy the support zone, right, and place your take profit at the or you take your profits at the resistance zone, and then you sell on the resistance zone, and that's basically it. That's the whole strategy. You could have done it here, buy, sell. Could have done it multiple times in here. You could have just bought once and sold once, right? So that's the first way you can trade it. The second way to trade it is a breakout, right? So breakout traders, what they wait for is they wait for either the support or the resistance zone to be broken. So it's getting wedged in between the support and resistance. The candles are getting wedged, and then eventually it's going to fall out or break up above the support and resistance. So in this case, it broke below the support, or broke below the support. So what a breakout trader would do is he would see this happening, and he would place a sell. So he would take a trade here and make money off it going down, right? That's what a breakout trader would do. The same here. It eventually breaks resistance, breaks out of resistance. Breakout trader, he just take a trade here and ride it up, right? He would buy when he saw the resistance is breaking and make money. And the third way to trade it is a break and retest trader. So a break and retest trader, what they'll wait for is for a price to break under a resistance or over a support, and then they'll make their play when the price comes back to that zone on the opposite side. So here we have a support zone that's broken. So the first trader is taking trades here and here and here, and then it breaks out, and the second trader comes in to take the breakout trade, and the third and final trader takes the trade when price comes on the underside. Alright, so those are the 3 ways to trade support and resistance. They're very simple, very easy, very profitable ways to trade support and resistance. It's one of my favourite strategies. The same here. Now, this move is pretty shit, to be honest. They're not always going to be big moves, but again, you can see people are still buying the opposite side of this resistance zone. So, there you go. That's support and resistance explained as quick, easy as possible. That's all you need to know about support and resistance. You don't need to go into it deeper. It's just points of interest. The chart is like a pinball machine. All it's doing is bouncing from resistance, support, breakout. So you have resistance, support, breakout. So yeah, all the chart is doing is bouncing from support and resistance zone to another one, to another one, to another one. That's all it is. And that's how you can trade it. 3 ways to trade it. Some examples. There you have it. Alright, lesson 6. Lesson 6 in this series, trend lines and Fibonacci. So, what is a trend line? A trend line is just simply put a support or a resistance line in a trending market. So, you can see here, if it's trending down, there's a top trend line, a resistance line that's diagonal, that's slanted downwards, and here's a support line that's slanted upwards in an uptrend. So they're literally just support and resistance, like I went over in the last lesson, but they're diagonal. So that's all they are. What do they look like? That's what they look like. I have a couple of examples here, I think. I have a couple of examples up on the chart. Here's just a very simple trend line. That's all it is. You just mark a low point to the next low point and it just follows along. Eventually this is going to break like a range, like a support or resistance, and that's all it is basically. It's just going to keep going along this trend line until it breaks. So if you tilt your head, you can see it's pretty much like say a resistance line, for example, here. It's just another point of interest. It's just another part of the pinball machine, like I called it last lesson. It's just another support and resistance line, another point of interest. The price keeps bouncing. So how do you draw trend lines? Well, it doesn't, like, people say you have to make it really exact, and your trend line has to be exact to the pip, and it has to be exact on the very bottom of the wick, and you have people have very fine rules for trend lines, but then when they draw a support or a resistance line, they kind of draw a box or a zone that are not as exact with it. So it doesn't have to be exact, right? You don't have to have your trend line absolutely exactly right, because if you just mark the basic, like what, not even the basic, you just mark a trend line and you get the rough idea of what it's going to look like without going into different time frames and trying to get the exact point where it starts. Like, for example, if you had rules or anything, you could say, okay, well, the trend line has to go from the low to the next low, which means it would go here, but it wouldn't match up as well, right? So I just did what looks the best, and that's the trend line, and that's what I'm going to have in my chart if I was to trade this. So your trend line doesn't need to be perfect, right? You just got to find a low point that keeps getting hit. Like this, for example, would be a trend line, right? What you would do is you would just go from the low to the next low and just drag it along. Now, it didn't really hit it anymore. Like, it didn't really hit this, to be honest. I wonder, like, it didn't really hit this trend line anymore. It kind of came near here, but didn't really hit it anymore, right? So, like, not all trend lines are going to be exact. Not all trend lines are going to work, and you don't really need to make your trend lines perfect, right? Like, this, for example, this is called a channel. I'm going to get onto it now in a second, but again, the trend line doesn't have to be perfect. It doesn't have to match up at every wick. Just find a point where it's going up or down, and where is it bouncing, right? That's it. Where are these wicks bouncing? Where are you getting rejection candles, engulfing candles? Where is it bouncing, right? So if we go back here, so what are channels and squeezes, I like to call them? So a channel would look like this, right? And the channel is kind of interesting. I kind of like channels. So what you're going to have is you're going to have a bottom or a top trend line, right? You're going to have a support or resistance. You're going to have a bottom or a top trend line, right? So say you have a trend line that's like this, right? It's going up on the bottom. What you can do, if you Control C, then Control V, if you copy and paste the trend line on the bottom and then you apply it to the top of the range that's going up, then you can get what's called a channel, and price will just bounce in between the channels. So what a channel is, in simple terms, is just a range. It's just a range that is going up or down, right? It's a trending range. So have an example here. I think here's an example again, like I just said, a channel. You have a bottom half trend line, copy and paste it to the top, and you get this kind of going up shape, right? Or you can apply it like, here's another one here, right? It wasn't perfect, but it still formed one if you just look at the shape of it. There's another one here, right? Like, all the trends are just channels, right? It would be the same if it was going down, you know, if this formed a downwards trend line. You would say, okay, this went down here. Hypothetically, if it went down, you would just copy and paste it, apply it to the bottom, and that's the range you're going to be trading in, right? So, go back to this chart here. The next thing is squeezes. So, what are squeezes? There's a few names for these things, but I don't know, I'm just going to call it a squeeze because it's easy to understand. So what a squeeze would be is when you have sort of a trend line, right, and say, for example, an upwards trend line or a channel, and, you know, there's nothing really stopping it from going up or down. There's no real points of interest or anything until you meet a real point of interest. Right, you meet a real resistance line. This is a resistance. It was a support. It was a point of interest. You had a support here. It broke under, went over. It's kind of a weird line, but it's still a point of interest, right? And the trend line forces price up into this line. The trend line forces the price into the point of interest, which then kind of squeezes, so it's bouncing, it reaches a point of interest or a resistance or a support, and then it squeezes it between the trend line and the point of interest, and it either falls out or breaks up, right? So for example here, you had a channel that was pushing price up. People were buying the bottom, right? People were buying the bottom trend line, etc. It pushed price up into this point of interest, or your resistance line, and it then dumped and had a breakout off it, right? Usually these, here's another one, right? You have a channel type shape. It wasn't a great channel, you wouldn't really trade this in my opinion, but you have kind of a channel here, and eventually it's going to reach its end. You had a point of interest over here, these two wicks, which line up with this. Very common pattern you see, and squeezed up into this zone here and dumps down, right? So that's what it is, right? That's what a squeeze is. That's how you can trade them. Again, 3 ways to trade it. You can buy the bottom or the top, or you can buy the bottom, sell the top. You can trade breakout, or you can trade retest. Break and retest. Those are the 3 ways you can trade it. So that's it. Again, how can I trade them? You can be a normal person and you can just sell the tops of these kind of trend lines, or you can buy the bottoms. You know, if you have a channel, you can just buy the bottoms, sell the tops, whatever. If you are a breakout trader, you want to trade breakout, you're going to wait for the breakout, you're going to wait for the squeeze and then trade on the breakout. You're going to take a position based off that. Or if you are a retest trader, you're going to wait for a breakout and then a break, basically a break and retest. So if this were to break, right, if this were to come down, the breakout trader would have already taken his trade. He would see, okay, it's breaking out here, and he would take a trade down, right? And then the retest trader will wait for the price to come back up, because most of the times it does. He will take a trade here and it will continue off, right? So that's kind of the 3 ways you can trade trend lines. Trend lines is the ways you can trade it. So that's all for trend lines. All you need to know. No need to overcomplicate them. That's what trend lines are. So next up we have Fibonacci. Now this is a bit of a weird one, right? So Fibonacci is, what is it? It's the golden ratio. You know, you can see it in, well, it was brought by the actual mathematician Fibonacci in like the 1200s or something, but you know, it's the golden ratio. You can look up what is Fibonacci, what is the golden ratio. It's all in nature. It's basically, you know, it's a mathematical thing. Anyway, I won't go into that because it doesn't matter. So what is it in trading? So in trading, you're going to have a tool up here, the third from the top on the drop down, called Fib retracement, right? and I'll teach you how to set it up properly. So you grab your fib retracement, you click and drag upwards or down, doesn't matter, and what you're going to see is a lot of lines, right? I'll apply the default here, okay? I'll apply default, so this is what you're going to see, right? First time trading, this is what you're going to see. So what you want to do is double click it. You're going to bring up this. You want to click on this one. You want to deselect this, 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 and this. So you should only have checked the 0, the 0.382, 0.618, 0.5, and 1. After you've done that, scroll down, you're going to see background. Click off background. Then click on use one color and make it black or something. Then get rid of the trend line. And you're going to have this. So go and do that with your fib retracement. This is the best way to have your fib retracement in my opinion. The most commonly used, most popular, strongest levels on it. So after you've done that, you're going to have this. So how can you use this to your advantage? So what price will do is usually, typically, if it makes a move up, right, it's going to have a pullback. So if price comes up, oh shit, right, hold on. Alright, we're back. So what is wrong with this, man? So if price were to move up, right, you had to move up, eventually it's going to have a pullback. You're going to hit a resistance, like I've said, you're going to hit a resistance or something, and you're going to have a move down. So you're going to have candles that come up, then it's going to come down. So what the fib is good for, you measure how far it's going to come down after it comes up. So you have this type of trend line that comes up, eventually it's going to come down. That's when you draw your fib. You draw your fib from the bottom to the top, right? And typically price will hit one of these three levels and move off in the other direction. So price usually, if it's a small pullback, if it's a small move, it'll hit the 0.382. If it's a big move, it'll probably hit the 0.618. Those are the two best levels, right? The 0.5 is okay as well, but the 0.382 and the 0.618 I've seen are probably the strongest levels that have the biggest reaction. So I think I have a couple of examples laid out here. So, just for example, right, this is just something I marked out, just 2 seconds. I just saw this. You have a down, you have a up, down, you have a low. That makes an up move, big up move. How far is it going to pull down? You have here the 0.5 fib. It hits pretty much fairly close to 0.5 fib and moves off again. Now that wasn't great, but that's just a simple example, right? I'll try mark one out right now, actually. You know that? Let me find something. Let me go on like USD Swiss, right? Let me go on USD Swiss. So you have a low, a high, and bang. There you go. It comes back down, as I said, to the 0.618 before moving up again. And now it's going to go on sideways. But again, the 0.618 is probably the strongest level, right? Because it had quite a big move up. Where's it going to pull back to? The 0.618. If it has a small move up, it'll probably come back to 0.382. But for instance, sometimes it'll just go straight to the 0.382 again, like it did here. Came up, had a small pullback to 0.382, moved up again, right? So that's how you would draw them out. That's how you would see them. So how can you actually use fibs to your advantage? How can you use fibs such as support and resistance, trend lines? They're all useful. You know how to trade them, the 3 ways to trade them. So how can you trade Fibonacci, right? What you can do with Fibonacci is, it's interesting. Say, right, let me try find an example here. You'd have an up move, like so, right? So you have an up move here, right? Let me just get my tools ready. So you have an up move, you have a support, right? And this is what's called confluence. So what we have here is an area of confluence. So before I added the fib, what we have, again, now it's coming together, now that I'm showing you different things, you have a trend line. The third touch, remember, this is actually, I forgot to say this, the third touch of a trend line is always the strongest. Remember that. So you have your trend line. Okay, you can mark this out yourself. Remember, practice what I'm telling you on your own chart. So you have a trend line up, you're going to have a support zone. It's going to hit the trend line. But for an extra confluence, you can see where that is going to be on the fib. So for instance, right here, it was on the 0.5 of the fib. So now you have a support zone. Like I said, you have a trend line, and now you have a new thing called a Fibonacci. So Fibonacci isn't too important, but you can use it to your advantage, right? Just an extra confluence, right? Just to reassure you that the trade is good. It's an extra thing that people are going to be looking at. So that's basically it. You know, there's nothing else to know about Fibonacci. You don't need to you don't mess with the settings of it. You don't really need to, right? There's no need to do any of that. What everyone else is going to have in the chart is what 90% of people are going to have their Fibonacci as, is what I just told you. Don't change it. Don't listen to these people on YouTube using really weird fib levels. It's not going to work, right? And trend lines, very simple, don't overcomplicate it. Third touch of it is always the best. They're just support and resistance lines, but diagonal, alright? Hope this was a helpful video. I think this is the longest video yet, but it's a very helpful video. So what I want you to do now is go on the charts, tradingview.com, like I said, go on the chart and mark out some trend lines and mark out some Fibonacci, right? Mark out some trend lines, mark out some Fibonacci. You know, when you see a up move, put a Fibonacci on it and see which one it hits, right? If you have an up move like this, just put a fib, drag a fib from the bottom to the top, right? Fib from the bottom to the top, fib from the bottom, like for example here to the top. I already know that hit the 0.382, bottom to the top, bang, bottom to the top. And again, if it's going down, you do from the top to the bottom, top to the bottom, draw your fib, right? That's how you draw fib. So I want you to go and do that on your chart now. Check out some trend lines, check out some Fibonacci, and try it out. So I hope this was a helpful video. It was a pretty long one actually, so yeah. Alright, episode or lesson, I think it's lesson 7 now. I think it's lesson 7. Kind of a short one. We got chart patterns, alright? So chart patterns are just patterns. They're just like ways the market moves. They're ways the candles move that they do over and over and over again, right? Like chart patterns are going to be here forever, right? It's just certain things that the market does, right? Certain things that the candles do that you can identify before they happen and make money off them. So a couple of the common patterns we have, I'll draw them out. A couple of the common patterns we have is something called, number one is a head and shoulders. So a head and shoulders would look something like this, right? You have candles coming up, then you have a move down, then you have the candles coming up above the recent high. It'll then come back down, right? And what it'll do is form this kind of three things, and these three kind of pyramids, three kind of triangles. The two on the outside will be equal height, and then you got this kind of like apex, right? So what the candles do in a lower time frame, if you look at it, you'll have a bullish move up, you'll have a bearish move down, bullish move up, you'll have a little dip in the middle probably, it'll come up again, move down, retest this point. This point is the point you want to focus on, right? The rest of it doesn't matter. You want to focus on this point here. So I'll show an example right here on NAS. As you can see, we have a high point, right? You make kind of a neckline, it's called. You got the bottom line, right? You got this bottom line along the bottom. It comes down, retouches it, right? It comes down there. Then it moves up again, breaks the high, then it breaks back down and comes down here. As you can see here, the little thing it does in the middle, right? You got this. So you got this pattern, right? Up, down, break up, break back down, and this is the point, right? Pay attention. This is the pinnacle of the head and shoulders. This is the best way to trade it. You want to just trade it. You want to take a sell position here on this point, right? So when you see this thing that does this, when you see a pattern that comes up and then breaks back down and rejects, so say it's like, you know, like here for example, you can see, you can anticipate what it's going to do. Right? If you're looking at this, you think, well, what's it going to do? It's going to, like, we have this low here, we have this low point, and then we have this recent high, right? We're forming the pattern. What happens next? It comes up, taps into that, and moves down, right? So that's what happens, right? That's probably the best chart pattern you can get, and probably just the best one, right? So that's how it plays out. You gotta take this point. This is the most pinnacle point, and how you can spot it before it happens is if the candles, they move up, you have an up move, it comes back down to this low point, then it comes up, it breaks to this high point, then it comes back down to the low point, then you want to wait for the retouch on this point, and it'll move down and break this point. That's the best way I can explain it. There's only like a couple more chart patterns that are actually useful. You have like a double bottom, let's say double bottom. I think I have one marked out, double bottom. So like something like this, right? Just a simple, you make the candles make a low point, it has a reaction up, you come up like this, so you make a low point, it comes up, then it goes back down to the low point, like here, and then it moves up again. So after it makes a double bottom, you can probably expect it to move up, and if it moves up and comes back down, right, to the double bottom, so you make a double bottom like this here, and if this were to move up and come back down again, you can expect a triple bottom, right? That's the most you can have is a triple bottom, and then it moves up. But it didn't. It moved off the double bottom. But if you can get a triple bottom as well, so it's just, it comes down once, twice, then it moves up, right? And the thing is with these double bottoms is that eventually the price will always come down below this. Price will always eventually, the move is started by this, you get a lot of bullish rallies off this, and then it just breaks it eventually, right? So you can get double tops as well. You can get double tops. You can get basically, I'm gonna try find an example of a really nice one if I can. Here you go, right here. What it just did, you have a high point, it rejects the high point, and you have a very strong move down. Now it could have rejected any of these high points. There's no real way of knowing, but this is the way that it went. It just rejected this high point up here and moved back down. So that's it. That's the most important ones. That's the most important points, the most important patterns. So you can look up on Google, like, you know, head and shoulders and double bottom, double top. So I'll write them out. You got one, the best is head and shoulders, right? It's the best one. Then number 2 is double top / bottom, and then number 3 is probably just a triple top / bottom. Actually, there's one more thing that I want to show. It's called a wedge. So what I went through, it's basically just price is getting wedged in between 2 points. Eventually it hits a point of interest and it falls out. So like you can see these wedges everywhere, right? You can see wedges everywhere. Here's another head and shoulders, by the way. Again, another head and shoulders. High point, back down, up, back down, retest, and goes down again. This is the point you want to be taking right here, bang. You know, this is the best point to take a trade on. So you got one more thing, and what price will do is it'll wedge itself. So I can't find an example right now, but what you're gonna see is you're gonna have a trend line going down like this, and you're gonna have a trend line going up like this. And what the candles will do is they'll come in and do this, right? You're gonna see this a lot. Candles will come in and do this, and eventually what's gonna happen is people are gonna buy or sell it out of it, and it'll just break up, right? Or it'll break down. But those aren't as good, you know what I mean? I don't really trade them. I don't really see them too often. And see, there's a problem with chart patterns is that they're not extremely reliable. The only one you should really be trading, in my opinion, is the head and shoulders. Head and shoulders is probably the best, most reliable thing you can trade because it just works the best. So take away from this video, write down head and shoulders, study head and shoulders, and only trade. If you want to trade patterns, just trade head and shoulders. So that's all I have to say. Just there's a few common patterns. That's how they play out. They're not that important. They really aren't that important. But if you want to trade them, you want to take them into consideration, only trade head and shoulders, right? In my opinion, anyway, head and shoulders is probably the best one. All right, lesson 9. Well, it's not really a lesson. It's kind of just a how-to, basically. It's kind of just like a fucking tutorial, right? So now you understand the basics of trading, right? You understand simple technical analysis concepts. You understand simple methods to trade, right? You understand support and resistance. You understand break and retest, trend lines, Fibonacci, all of the basic shit that you can use to develop your first strategy. You understand time frames. You understand, and again, you want to use a simple strategy to trade as a beginner. You want to use a simple, easy strategy on the higher time frames to trade as a beginner, because if you go straight into something really complex, then you're going to just end up losing more. Your emotions are going to overtake you. You're going to lose lots of trades, and you're going to just get fed up and end up quit trading, right? So that's why that's basically the main idea of why I made this course, is because I want to help out beginner traders get introduced into the market in an easier way rather than going straight into some bullshit, right? So what you want to do is you want to open up a new tab on Google, and you want to type in MetaTrader 5. Alright, so download MetaTrader 5, open it up, open up the website and download it for whatever you're on, whether you're on a Mac or Windows or whatever you want, right? Just download MetaTrader 5. You can download it from the Play Store if you're on a phone as well. So download MetaTrader 5. Sign up, make an account, right? I can't tell you much more than that other than just make an account, right? Now, you can also trade on MetaTrader 4 if you want, but MetaTrader 5 is the newer one, and there's more stuff to do with it, right? So MetaTrader 5 is probably the one you want, right? So once you've downloaded MetaTrader 5 and you've downloaded the app and you have an account and you have it all set up and everything, again, if you have any problems with this, just message me. But once you've downloaded MetaTrader 5, you want to search for something else called Position Size Calculator. Search this exactly, Position Size Calculator download. Okay, so Position Size Calculator for MetaTrader, earnforex.com. You want to search exactly this, and then click on the first one that's done by earnforex.com. Open that up, and you're going to see this page, alright? And you want to scroll down past all of this shit. You want to scroll down all the way, keep scrolling, and you're going to see something. Wait, here, once you come down to the place where it says downloads, you're going to see this like yellow box and these green writing and shit. So you want to download it for MetaTrader 5. You want to click it, download it, right? I'm not going to download it because I already have it, but you want to download it, right? And it has it shows you, this whole page shows you what it does, right? So this is the next thing. You want to download it for MetaTrader 5. So then open up, well, you can do it for MetaTrader 4 as well. They're both pretty much the same. So open up MetaTrader 5 or MetaTrader 4. Once you go into this, what you want to do is over on the left here in your navigator, you can open your navigator by hovering over view and then clicking navigator, right? And you want to drag it over to the left. So once you've opened up navigator, by the way, this is just a demo account where I was just testing shit out, so don't worry about the balance or anything. It's not a real account, it's a demo account that I was testing stuff out on. So after you've opened up MetaTrader, you have downloaded a position size calculator and you have it on your computer. Then you want to put it into MetaTrader 5. Now, I can't do this again because I already have it on both MetaTrader 4 and MetaTrader 5. If you want, you can look up a quick YouTube tutorial or something on how to put it in to MetaTrader 4 or MetaTrader 5. But it's fairly straightforward. You just want to drag the file into MetaTrader, right? It couldn't really be simpler. Just drag it into MetaTrader. And once you've done that, it'll be over here in Navigator. Open up Navigator. And then come down or click on indicators, right? And then scroll down till you see position size calculator. Hit the plus on this till it turns to a minus. Click position size calculator and click and drag it on to your chart. This will pop up. Press OK. There you go. Now you have your position size calculator. Now I'll run through what this position size calculator is quickly, how to use it. You're only ever really going to want to use this main option here. So quickly I'll run through the different types of orders that you can do, right? This is kind of important. I think I forgot to go through this recently, but once you have this open, you can click instant to turn from instant to pending. Alright, so what instant means is if I open up a chart here, for example, if I open up a chart, for example, if I go to like your yen or whatever. So what is an instant trade? As you can see on over here, what is an instant trade, right? So an instant trade basically means, oh shit, I think I just opened MetaTrader 5, but an instant trade on MetaTrader or on position size calculator means if price is here, you click instant, you would basically sell here, right? And this would be your stop loss, your take profit. That would be your entry, right? This is where you would actually buy or sell in the market, right? You would short or buy in the market. Short is you want the price to go down. A buy is you want the price to go up. You should know that by now. So that's what an instant trade is. And what a pending trade is for example, if you are maybe a break and retest trader and you see there's a point of interest. Oh shit. Down here. What a pending order is you would place your little tool here, the tool over here, to check what it is. Actually, I should have went through this in a recent video, but I'll go through it quickly. Basically, to see where you want to buy and sell, you open up this over here. It'll have this little icon, the second from the arrow or the emoji thing, long and short position. So a long position is basically you press that down, you can adjust what price your stop loss is going to be, and your stop loss is just once you're in a trade, if price goes down to your stop loss, it will take, oh shit, my book just fell, it will take you out of the trade. So once price hits your stop loss, you want to place it wherever you want at a safe spot. Once price comes down and hits your stop loss, you'll be out of the trade. So it'll come up, it'll tap you in, you'll be in the trade right here on this line, you'll be in the trade, so you went for a long, it goes up, whatever, and if price comes down and hits your stop loss, it will take you out of the trade, so you will, it'll prevent you from losing more money. That's why it's a stop loss. And then your take profit is just where it will automatically close you out of the trade if you're in profit. So if price did come up here, once it reached here, you'll be out of the trade with your profit, right? So that's just that's pretty much what it is. So if you're buying, you want to hit long tool, right? And I don't know, say for, I don't know, your stop loss could be here. This is just hypothetical and your TP is up here or something, right? So, say you place this trade, right, if you want, hypothetically, your stop loss is here where it will take you out of the trade if it comes down, so you prevents you from losing more money, and this is your take profit up here, which means it will take you out with profit. You want to double click this, okay, and you want to double click it. You'll have entry price, profit level, stop level. So this is where you want to copy and paste. So your entry price, okay, for example, you want to hover over this, Control C, right, copy it, and then with a pending order, place your entry here, copy and paste. Okay, well, I'm on the wrong one here, but I'm on a different pair. But for example, place your entry there, right, go back to the chart, copy and paste your profit level, alright, and take profit, and then copy your stop level and put your stop loss here. So what this means is when the candles, when price comes down to the price of 141,145, which is down here, once price comes down here, you will buy some Euro JPY. You will buy and you want the price to go up. So you've bought, hoping price will go up, okay, which is likely since we are in an uptrend. So you've bought here, and whatever, you can do whatever. And if price does come up here, you will hit take profit and you will make money, right? Because your take profit is up here and it will automatically get you out of the trade once you make profit. Or if you're unlucky and the trade comes down and it takes you out at your stop loss, if the candles come down to this bottom grey line, it will take you out of the trade. So it'll take you out of the trade and it'll prevent you from losing more money, because if, for example, it can go all the way down here and you could have lost way more, but the stop loss is protecting you from losing more. So that's how to use a pending order, right? You're gonna copy your entry, paste it in here, copy your stop loss, paste it in here, copy your take profit, paste it in here, okay? And then to actually place this trade, you're gonna scroll down to Expert Advisors, click this open and double click PSC Trader. So double click it and you will have, I'll double click it for example. Alright, well it's not working on this demo account because it's some different demo account, but you want to double click PSC Trader and what will pop up here is an order. So that'll just say your order. So that means the price hasn't come down to that area yet. It hasn't come down here yet. So you're still waiting on it to come down there, and if it's above this balance line, you'll be in the trade. So price will be, you'll be in the trade, right? So once it hits this middle line, you're in the trade. Once it hits this bottom line, you're out of the trade with a loss. Once it hits this line, you're out of the trade with profit, right? So that's what it means. That's how to actually buy and sell. A lot of people don't explain that. I almost forgot to explain it, but it's important if you're a beginner, right? You need to know how to actually buy and sell. So this tool here, long, short, that's what you want. Pretty much. So yeah, that's it basically. That's how you actually place a trade. That's how you actually make a trade. So yeah, that's it. That's Meta. You want to download MetaTrader, download position size calculator, implement position size calculator into MetaTrader. Then once you have an order, say you want to buy it here, get your tool, place it here, right? Place your stop loss where you want, place your take profit where you'll make money here, wherever you want. When price comes down, taps you in, you'll make money if it goes up, and it will take you out of the trade at this grey line, and if it goes down, it'll take you out of the trade at this bottom line. That's it. That's how you actually take a trade. That's how you use a trade easily, or that's how you use position size calculator easily, and how you actually take a trade. the foreign exchange is, it's a marketplace where people can buy and sell currency pairs. Now, what is a pair? A pair is just putting one currency against another currency and seeing what the price is. So, for example, we have Euro GBP up here.